Hey everyone, welcome to another episode of AdBits. I'm Adam Bergman, tax attorney and founder of IRA Financial. In today's episode, self-directed IRA and land trusts. So, should you ever set up a land trust owned by your IRA? Why would you set up a land trust owned by your IRA? And are there any advantages or disadvantages of setting up a land trust for an IRA? So start at the beginning. An IRA can own real estate. An IRA can make investments directly. There's only three things an IRA can't do. Probably heard this before if you listen to any of my podcasts or watch some of my videos. Can't do life insurance, can't buy collectibles like art, and you can't do any transaction under 4975. It essentially involves a disqualified person, you, your lineal descendants, any entities you control over 50%, and your IRA. Okay, other than that, you can do it. So now we know what an IRA can and cannot do. We know an IRA can invest in real estate directly. We should know that an IRA could use an LLC to buy real estate. Why would you do that? Well, you get limited liability protection. The IRA manager can manage that LLC. The LLC is owned by the IRA, but managed by the IRA owner, giving that IRA owner more control, checkbook control, and the ability to get investments done quicker, right? Because you don't need to have the custodian make the investment. The investment can be done directly by the manager of that LLC. But what about a trust? Can an IRA own a land trust or another trust? Now, technically, an IRA is a trust, taxed under 501. The IRA custodian technically is a trustee of the trust. So can a trust own a trust? The answer is technically yes. An IRA can be the grantor of the trust. The grantor is the one that creates a trust. In order to have a trust, in general terms, you need to have a grantor, a trustee, and a beneficiary. The issue is, can one party be all three? Could potentially invalidate the trust, but what happens if one party, the IRA, is two out of the three, the grantor and the beneficiary, and the trustee is the IRA owner? That's the way a land trust or any type of trust is set up. Now, why would you set up a trust instead of just having the IRA directly own the real estate or use an LLC? Well, the first is more in the lines of anonymity or privacy. A trust is a private arrangement, right? It's not filed with any state. It's not filed with the government. Yes, a trust has to file, depending on the trust. A grantor trust needs to file a 1041 return, although there are exceptions. A grantor trust is a trust created by the grantor, revocable or irrevocable. In the case of an IRA, most of these trusts are revocable, meaning the grantor and the trustee could revoke the trust at any point. An irrevocable trust means it cannot be revoked. Irrevocable trusts are used mainly for estate planning purposes to get those assets out of the estate, so it's not subject to estate taxes. But in the context of an IRA, IRAs are always part of an estate, so there's no need to do an irrevocable trust. The IRA owns a trust versus the LLC. Why would that ever happen? Again, privacy. With an LLC, you could find out who's the owner of that LLC. It's a little more difficult in Delaware, Nevada, Wyoming, but you can still kind of figure it out. Trust, you can't, right? If you call your trust XYZ Trust, the only thing they'll know is who the trustee is, because a trust takes title through a trustee. So the Adam Bergman trustee of the AB Trust. Okay, so people like trust more for privacy and anonymity. Obviously, it's free. Yeah, you need someone to create the document, but you don't have to file any paperwork with the state. The downside is there's no limited liability protection. Trusts have no limited liability protection like an LLC or corp. So if there's any liability in that investment, the trust will not protect you. It'll give you privacy, but it won't protect you. Now, in terms of tax filings, on a federal level, there are technically, you can file a 1041 grantor trust, but there's also different ways of doing it. You can essentially circumvent filing the 1041 as long as the trustee provides the trust income recipient with a W-9 and identifies who the payer of the income is and a statement telling the owner of the income that the trust is the owner. So there are ways to get around using the 1041, but there's still a little bit of paperwork that needs to be filed. And the trustee has some responsibility. Okay, so you would have to get the W-9 to verify the grantor's tax ID. This means having to work with the IRA custodian to confirm that the IRA is a U.S. person, which isn't an issue. But bottom line is you can get around filing the 1041 from a federal level, but the trustee still has to essentially certify that the trust is a U.S. person. Why is there no formal tax filing? Because technically the grantor is responsible for reporting the income. But in this case, the IRA is the grantor, and we know IRAs don't file taxes. So technically, from a federal standpoint, it's kind of clean, kind of like a single member LLC. However, from a state tax standpoint, it's more complicated than an LLC. A single member LLC generally does not have to file state returns. It may have to file information returns for annual filings. For example, Florida is a $140 or so fee, just essentially money grab by the state for doing business in the state. Most states have fees anywhere from $50 to $800. California is the most expensive. It's an $800 minimum franchise fee. A lot of people think they can set up land trusts instead of LLCs to save $800. The issue is California is super aggressive, and you still technically have to file a Form 541, okay, if there's income, California Nexus income, sourced income for a trust. So a lot of people don't realize this and say, oh, okay, you want to charge me $800 minimum franchise fee for an LLC? Forget that. I'm going to set up my own trust, and I'll never have to file the franchise fee. Well, there's still 541. There's still potential income tax that applies to that income. And you're not going to get around just any reporting requirements or fees. Okay, so it's not as easy as it seems. Some states, it could work, like Florida. Okay, it doesn't have any state income tax. There's no state trust tax. So technically, a trust set up in Florida owned by an IRA can get around filing the 1041 and technically doesn't have to report the income on a state standpoint. But there's 50 states. And the only point is this, trusts are a lot more complex than LLCs. LLCs, you can Google around and see, oh, I have an LLC in South Dakota, I have an LLC in Maine, I have an LLC in New Hampshire. These are the annual fees. IRA Financial helps all our clients with this. We'll let you know what the annual fees are. You can pay it out of the LLC. Some states like Missouri don't even have annual fees. But from the trust standpoint, it gets complicated because every state treats trust income differently. And you may not even be aware that the state that you have your trust income sourced in may not have any state income tax on the trust, but because you're the trustee and reside in a different state, that state may impose state taxation on this trust income. So it gets complicated because some states look at the trustee resident, some states look at the nexus of the trust income, some look at both. So my point is, hey, yes, the trust will give you more privacy because it's hard to figure out who owns it, but you're going to have far more disadvantages than the LLC. You have no limited liability protection. You have more complexities from a state tax filing requirement. And you also need to make sure that your trust will comply with state requirements because not all states treat trusts in the same fashion. So land trust can be used by IRAs. I've helped many clients do it. Some people just love trusts, okay? And you just can't talk certain people out of what they want, and that's fine. They just need to be aware that, hey, make sure you understand if your trust has income in Texas and you're a resident of Texas, okay, you only need to look at Texas to see any state filing or taxes relevant to the trust income. But if you are a resident of Maryland and your trust is set up in Virginia, hey, you may have two states you may have to look at to make sure you're complying with all filing and state requirements regarding the IRA-owned trust. So it's just an FYI. Most of these trusts are going to grant your trust. They're revocable. You could get around filing the 1041 as long as the trustee can show it's a U.S. grantor, U.S. beneficiary with a W-9. But from a state tax standpoint, that is the complexity that you don't have with LLCs. LLCs are more uniform. Other than California, Tennessee, there's really no other states that have franchise fees. Texas has a $1.1 million exemption. So other than just paying filing fees, for states for the pleasure of doing business in that state. It's not really complex. Single member LLCs have generally no state filing requirements from a tax standpoint, no federal. Multiple member LLCs do have to file a 1065 state and federal, but at least there's more guidance and uniformity. Whereas the trusts, each state looks at and treats trust differently in most cases. And then you have to look at the residency of the trustee, as well as the source of income of the trust to determine what requirements from a state standpoint you are responsible for as the trustee of the trust. So it's more complicated. You can do it. It's more complicated. I personally advise clients to use the LLC. I think having limited liability protection is more paramount and more important than privacy. But again, some people just love their privacy. I say, if you want privacy, set up the LLC in Delaware, Wyoming. It's awfully hard to find out who the owner is. All generally that could be identified online as the registered agent. And the operating agreement's a private document that's not filed with the state. So if you're really focused on privacy, just do a Delaware, Wyoming LLC. Yeah, there's an additional fee if that LLC is also going to do business in a different state, but at least you get your privacy, plus you get your limited liability protection, plus you don't have to deal with potential tax nightmares from a state tax perspective. So I'm just a big proponent of the LLC over the trust. Not to say that if you want to use the trust, you can't do it with an IRA. You can. You just got to be cautious of some of the state tax potential pitfalls. So there you go. I hope you guys enjoyed today's podcast. Really interesting topic. Having an IRA, a trust, own a trust, and some of the intricacies involved. So this was kind of fun to prepare for. I think I was probably the first back in 2010 that let my clients use trusts. I kind of backed away from it, by 2011, just because I saw too many clients that weren't aware of the state tax ramifications. And to me, it just was too risky from a compliance standpoint, not from an IRS legality standpoint, just more from a compliance standpoint and making sure that the clients are filing and paying all related state trust taxes. So thanks again for listening. If you're watching on YouTube, don't forget to subscribe. It's a great channel. Drop 3 podcasts, 3 to 4 videos a week. And I do a YouTube Adam Live, which generally happens every Wednesday at noon, but I could surprise you guys and just do a different day. I generally do that. So just a good way to stay in touch. Subscribe. You'll get notifications when I go live, when the videos drop. And obviously you can catch our podcast on our YouTube channel as well if you care to look at me. If you don't want to look at me, and I don't blame you, you can just listen to the podcast on Spotify, Apple, SoundCloud, or wherever you pick up your podcasts. Otherwise, I hope your summer's going great. Thanks for spending some time with me today. Really appreciate it, and take care.